Let me know when we're live. Hello everyone, good morning, good evening, good afternoon. We are on session 9 of MOOC 15. This is the session on regulatory matters, legal matters. As always, I note with some bemusement, it is always the lowest number of participants of every MOOC. This session has the lowest number, and it always makes me sad because I think it's a very important session. I think it is a session that is both intellectually extremely interesting, extremely engaging. It allows you to understand something about the nature of the asset itself by trying to compare it with other things that we're used to in the traditional world. And it is also interesting because it gives you some guideposts of where you can get in trouble in this space and where you cannot get in trouble and what are things to worry about or not worry about. The objective is not, obviously, even if we did a whole course on this, it's not to provide legal advice or to turn you into a legal advisor or a tax advisor. The objective is to think a little bit about what are the types of areas that touch upon crypto assets, cryptocurrencies, what legal issues, regulatory issues touch upon them, and to build a very basic awareness of the types of issues. We have some questions, just a handful, which is understandable because, again, it's a short week again this week. And I'm going to go through those questions. Once I've gone through those questions, we can discuss further in the chat, which I'm taking a look at there. And we will see what else we can talk about. So I'm going to start with a tax question. And as always, this is not tax advice. Your situation may vary. Your country may vary. It's not. But I can answer the question conceptually. And the question is capital gains and tax calculations. Let's say today I buy one Bitcoin at $25,000. And later I buy one more Bitcoin at $38,000. The Bitcoin price continues to rise, so I decide to sell one of my Bitcoins at $45,000 for a profit. What are my capital gains? $20,000, $7,000, an average of the two? Or instead, let's say I sold one of my Bitcoins at $30,000. Am I making a loss or a profit? That's a good question. And it's a question that we will answer about Bitcoin, but the answer we're going to give is a generic answer about capital gains and losses, at least how it is done in the United States. And so, because there are obviously 210 countries in the world, everyone's tax laws are a little bit different. In this course, we tend to look at the US treatment on these topics, just because it's the biggest market, it's the most developed crypto market, and anyway, their approach is fairly normal, fairly standard. Many other countries are going to have a similar approach, so it's a reasonable, if you're going to pick one to walk through, it's a reasonable one to walk through. So, what the IRS, the Internal Revenue Service of the United States, has decided is that it is going to treat crypto assets as a form of property. I believe it is an intellectually reasonable position. They are saying if you buy a Bitcoin, Ether, a sushi swap token, or an NFT, or any crypto asset, it is as if you had bought a share of Google. It is as if you had bought a piece of art. It is as if you had bought a ship full of oil. It is as if you had bought an investment property. It is as if you had bought shares in a private company. It is something you have purchased with capital. And if you have a gain or loss, it will be characterized as a capital gain or a capital loss. Why do I think that's a reasonable decision? Well, on a simplified basis, taxes in the United States, direct taxes, are either classified as income taxes or capital taxes. Income taxes are those that are, for an individual, driven off their labor. I go to work, I have a job, I get paid a salary, income tax. I'm an independent contractor, I have a contract, I do a certain service for a company, income tax. Why? This is the income I earn in exchange for my labor, and I am charged income tax rates. Capital gains and losses are taxed on a different schedule. They are generally taxed at lower rates. Kind of one often initial reaction to tax rates is like, well, that's super unfair. The rich are really getting better side of the deal. They get to pay lower rates on their, because who makes money almost exclusively from their income? Well, people who don't have a lot of money, right? They don't have assets to invest, they're primarily earning off their income. Who makes most of their money on their investments? Well, people with a lot of money, a lot of capital. So you say, well, that's kind of unfair because this allows people with already a lot of money to earn money and pay lower rates than people with less money. And that's true, actually. Now, not necessarily on a total tax burden basis, but it's true, basically. And the reason is capital is more mobile than labor. And so it's easier to move capital around the world and find ways to effectively end up with lower tax treatment than it is to move yourself around the world and say, oh, wow, look, maybe in Palau the income tax is much lower, but my job is in Chicago. And maybe there's not a particularly easy way I can move to Palau to take advantage of that. But capital can move around the world quite a bit easier, so most countries, not all, tax it at a lower rate because they say, well, instead of, if we tax it at a higher rate, we might collect fewer taxes in total in the end because people will do more work to structure their affairs, to move it out of this jurisdiction or to find other losses to put against it, which these structuring opportunities are less relevant, harder to do on your income. You kind of go to a job, you get a salary, it's not really much flexibility. Where you earned it, at your employer. Where is your employer located? In New Jersey. Do you get any deductions against this? I mean, effectively, no. There's some small things, but effectively, no. So, capital gains rates are generally lower than income tax rates. So, and income tax or capital gains are the two main ways that earnings are taxed. I believe among those two, the IRS picked the more reasonable one. If you are, and not just the lower one, it's also the lower one, which is nice, but it's also the more intellectually justifiable one. If I buy a Bitcoin and then the Bitcoin goes up in value and then I sell the Bitcoin, has that been created from my labor? No, it's a capital gains. It's not like I was working every day to make it go up in value, and that's why it's not like someone's paying me a salary. So I think that treatment is right. And someone say, oh gosh, but I don't want it to be taxed. Well, sure, right? Nobody likes paying taxes. But it's a cliche, but it's a cliche because it's true. The only certainty in life is death and taxes, right? So the idea that uniquely crypto would be tax-free when literally every other part of human society is taxable, that's a daydream, right? There's no government that's going to say, oh, that's super great, we're going to tax people on whatever else they earn money on except crypto assets. That's clearly never going to happen. Yeah, but what about currency? You don't get taxed on US dollars. That's true, but you also don't make money on US dollars, right? Like when the asset in question is also the unit of account for the country, it's literally impossible to make money from it. So, yeah, USDC, Fed coin might not be taxable, but that's Fed coin is always going to be worth $1. So you're going to buy it for $1, and then later you're going to sell it for $1. And sure, you're not going to get taxed, but that's no different than if Bitcoin's price never moved, you'd also wouldn't get taxed. So I don't think it's something unfair to Bitcoin or crypto assets. So now generically, when you have capital gains treatment, you actually have a choice of ways to treat the answer to this question that was asked, which is you have 2 Bitcoins. They're fungible, right? You have 2 of them. And then you sold 1 of them. And the question is, did I make a profit and loss? Well, the answer to that question is, well, how much did I buy it for? And then the question that arises is, well, which one did I sell, right? And there's no answer, right? They're fungible, they're the same thing. So the IRS gives you broadly 3 choices. There's some other additional things, but 3 choices anyway. LIFO, FIFO, specific identification. What is LIFO? LIFO is last in, first out, right? So last in, first out in this case. Let's look at the example again. We sold one at 45. What was the last one in? 38. We have a profit of 7,000. Those are your capital gains. The tax rate, depending on its long-term, short-term, your income, etc., will vary between 0 and 28%, and plus your state taxes in some states. And so you will pay, in that case, up to a couple thousand bucks in taxes. FIFO. First in, first out. I sold for 40. I bought 45. I bought for 25. $20,000 times 28% up to $5,600-ish in taxes. And now it's sad, right? They're eating away your gains. Specific identification. In a case like this where there's only 2, it's going to come out to being the same as one of the other examples. But let's say you had 10 Bitcoins and you bought them all at different prices. You could even say, no, I actually sold this one. This one that I bought at this price, I've sold at this price. Now, in the long run, it may not matter if in the long run you plan to sell all of them. Eventually, you're going to use all your different cost bases. In the short run, though, it might matter. In a year, you might want to, I'll give you some examples. You might mostly, you would say, defer the one with the bigger gain, right? It's not a permanent rule, it's a probable rule. So if you told me which one would I do, all else being equal, if I only sold one, I'd take the 7,000. Now why? Well, a couple reasons. Money now is worth more than money later. So if I'm paying taxes on 7,000 of gains, and let's say the prices stayed exactly the same forever, and I was going to sell the other one in 3 years. Well, there's a bigger tax bill in 3 years. I'd rather pay the bigger tax bill in 3 years than the bigger tax bill now and the smaller one in 3 years. So you would pay you take the 7,000. Also, prices go up, but prices go down. Maybe when I sell the second Bitcoin, things will be sad. Maybe it'll be 25,000. Maybe my $20,000 gain will go bye-bye. So if I've decided to sell one because I want that $45,000, I should pay the minimum amount of taxes I can pay now, because in the future, maybe the price of Bitcoin will have fallen. And so I would have never had to pay the $20,000. Whereas if I pay the $20,000, now, even if it falls, it's not like I'm going to get it back. That one's gone. This person also gives another intermediate, interesting example. It's 30,000. Am I making a loss or profit? It depends. Depends which method you use. You could say either one. Now, there's also some reasons you may not want to handle it this way. Let's say you have a lot of losses from something else, and those losses are expiring this year. And if you don't sell, if you don't find gains to offset against those losses, the next year you can't take your tax losses. So it's use it or lose it. They're in a year where they're expiring. Well, in that case, you might want to pay the higher capital gains, because anyway, you have the losses. And then over time, you'll see the time value of money is probably less important than the losses. It's pretty low discount rate these days. And you'll see what happens later. So the short answer to this question is all the answers are correct. It all depends which one you'd like to do. And the long answer to this question is all the answers are correct, and you have to look at your overall circumstances at that point in time to decide which one is more favorable. Now, over time, your flexibility diminishes. If you've decided to use the 38,000 cost basis for one of the two, and then later you sell another one, well, there's no flexibility left. You have to use the 25,000 cost basis for them. So once you make your decision, you end up being bound to it all the way through. But you do have some flexibility on how to make that decision. So that was very briefly, and it's funny because this is the type of thing that for some of the group will be probably very, very obvious, and for others might have been interesting. Now, we are going to go directly from this to a question that's highly related. It says, do you believe that most countries' decision to treat cryptocurrency as an asset, not a currency, is effectively parking the issue of it being used as a substitute for legal tender, by making it difficult for regular citizens to purchase small items such as a coffee, book, etc. with crypto? Due to their taxation policies, they're essentially controlling the growth of the space and almost forcing Bitcoin to be viewed as a store of value rather than a medium of exchange. I agree that their taxation policies effectively are helpful to the store of value use of Bitcoin as opposed to medium of exchange use of Bitcoin. I'm not sure it's exactly some master strategy, and I'll explain why. Now, for those who don't understand the subtext of this question, once you've concluded that Bitcoin is property and you're going to treat it with capital gains or losses treatment, it doesn't matter if you're selling it for cash, or if you're selling it for a book, or if you're selling it for a coffee, or if you're selling it for a car, or if you're selling it for a conference registration. You still have to treat it as a capital gain or loss. And so you go buy that proverbial coffee at Starbucks. It's $3.79, or probably more like $5.79 at Starbucks, right? And you pay with a few satoshis, a few thousand satoshis, I guess. Strictly speaking, you have to calculate for that transaction where those satoshis, how you want to treat those satoshis from a capital gains or losses perspective. LIFO, FIFO, specific identification, and say, oh, I bought them for $5.69, and now I'm buying the coffee for $5.89, and I have 20-cent capital gains, and I need to report on my tax return. Obviously, this is a gigantic nuisance. Obviously, for small amounts, people just don't do it. But people who have significant amounts say, oh, you know what? Never mind, I am not going to bother using this for transactions because I might be worried that the IRS might come audit my crypto assets. And if I have buying and selling, and they can see it, right, it's an immutable public record. So if people can see this, maybe I'm going to have to get into explaining what is this and what's the other thing, and what a nuisance. You want to have to keep records for every coffee you bought and calculate your taxes for every coffee you bought. You know who wants to do that? Nobody. It's horrible. It is actually a major hindrance on its use as a medium of exchange. They're going to say like, oh, it's a conspiracy. They want to protect the dollar. They don't want this to become a medium of exchange. I actually don't think it's that as much as it is. There's no other treatment that's really going to work in the current system. What are the three choices we said? Can be taxed as income. It doesn't fit conceptually anyway, that's worse. Can be taxed as property. We just discussed that. It cannot be taxed. Not going to happen. It's going to be taxed as currency. Yeah, but it can't be taxed like the US dollar. It moves against the dollar. And so, whether they want to or not, they say, well, they should just not do it. Yeah, but it's not just people buying coffees, it's also people going and buying, big players in the market, buying 1,000 Bitcoins, selling them for millions more. You can't open up a loophole, because that's what it would be. And the tax system say, well, because we want to let someone buy a coffee tax-free, we're also going to let Bitcoin whales buy 1,000 coins at a time and do that tax-free and sell them for gains and do that tax-free too. That's not going to happen. So what could you do is you can put a type of de minimis exemption. There is precedent for that in US tax law for individuals, not for companies, for foreign currency. And what does this mean? Now, foreign currency, right? There's no need for a de minimis exemption for dollars, because for dollars you can't actually gain or lose in dollars using dollars. And the de minimis exemption is $200. It's not very much, actually. And it's meant to cover the following situation. It's pre-COVID or post-COVID, and you could go on vacations. And you pick up with your family and you go to Paris. And Paris, as we know, we use euros. So the airport you exchange dollars, we don't have euros. You're going around Paris, buying a baguette. You are buying a coffee. You're going to go buy something fashionable, a scarf, a dress, etc. And then you go back to the airport at the end, and you change back to dollars, and you go back home. Well, even though the tax rates, the exchange rates between the dollar and the euro don't move around as much as the exchange rates between Bitcoin and the dollar. They do move around. So very strictly speaking, across that whole exercise, you bought euros at 120. You spent them at 121. You bought dollars back at 119. You might have gains or losses, just like in the example of Bitcoin. Since the number of people in world history that have gone to the IRS and said, look, I lost 1/10 of a penny, or I gained 1/10 of a penny on buying a postcard in France on my vacation. I want to report this on my vacation, are zero, right? Like, it's nuts. No one's going to do this. There's a de minimis exemption to cover people like that. So say that, look, if it's less than $200 of currency gains or losses, don't bother, you're exempt. You don't have to file anything on your tax return. I believe it is a very reasonable position for governments to take a similar view on crypto assets I think the number should be significantly higher than 200, both because they're more volatile crypto assets, so your gains and losses are going to be higher. And also because $200, this rule was passed quite a while ago. $200 means less now than it used to. If you said it was $1,000, $2,000, Brazil, I think it's $5,000. They have this rule already. They said, look, you have less than $1,000 every year of gains or losses from your crypto assets. That should cover you for buying coffee or a book or what have you, while not opening the door for you to have massive trading gains and them being tax-free. Because even in the existing system, if you had massive trading gains in euros, they would be taxable. You wouldn't get a currency exemption of some type, right? Like if the de minimis exemption is for small amounts of your personal spending. If I set up a business and I was a foreign currency trader and I was somehow the next George Soros and I was successfully trading euros for dollars and making money, it's going to get taxed. It's going to get taxed just like if you're trading Bitcoin for dollars. So I believe in effect the current policies suppress crypto assets as a medium of exchange to some degree. The other thing that's suppressing them is everyone believes they're going to go up in price and no one wants to use them. Right? And it's a luxury problem, I guess. It's been mostly true for the last 10 years. It won't be true forever, obviously. Nothing can just go. Nothing can go up 100, 200% a year forever. Eventually be bigger than the whole universe. But it has been true for quite some time. And but I don't think the reason is a conspiracy. There's kind of no other way to slot it into the pre-existing tax system that doesn't lead to this outcome. And particularly if they do a de minimis exemption, then they're definitely not. It's definitely not a conspiracy. It's just a sensible way to slot it into the current system. And sure, might there be some cost to that system? Okay. Does Bitcoin end up being more a store of value than a medium of exchange? Yes, it does. Okay. Is this some grand societal problem for the U.S. government? No, I don't think so. And I'm not saying they even particularly want it to be a medium of exchange. So by taking a normal approach, consistent with existing rules, probably on the margin it actually helps this topic, and eventually they're going to say, well, look, we're going to come out with a digital Fed coin. It's $1. You won't have these issues. You can use that for a medium of exchange. And it's not 100% wrong as a logic. We're not saying you can't use Bitcoin as a medium of exchange, but okay, then you have to pay your taxes. Okay. Tricky question. It's coming up. I'm going to take a drink of water to think about this one. The question is crypto so diametrically opposed to existing models of government that it will not be allowed to succeed? I.e., will CBDCs, central bank digital currencies, eventually become the only legal tender coins? Will privacy coins be outlawed under KYC AML rules? Will the crypto dream be strangled by the regulatory constraints of the existing centralized system it had originally hoped to subvert? Depends what succeed means, I think. Crypto assets used to be a rounding error of a rounding error in the financial system. They are now, I don't know what the latest number is, $1.7 trillion of market capitalization. That's not an asset that the existing models of governments have not allowed to succeed. They have allowed it to take up almost $2 trillion of market cap. You say, well, they don't really have a choice. People bid it up. Of course they have a choice. There's always a choice. They could say, Bitcoin is illegal in the United States. Well, people can still trade it. Yeah, sure, they can. But the number of people who would be, Coinbase would close, right? The number of people who could buy one would drop by 99%. The number of people who would be willing to buy it would drop by 99.99%. The price would crash. Would it go away? No. Would it still be there? Yes. Would you be able to move Bitcoins around? Sure. Would it be economically hugely successful? No. So there's no way to really look at the Western governmental response to crypto assets and say, oh no, they've gone full out war against them. They have not. What are they worried about broadly in kind of different buckets? The first one that is both something I think they're legitimately worried about, but also it's a convenient catch-all to implement all types of systems of controls, is the famous KYC AML, know your customer / anti-money laundering rules. I believe they're well-intentioned. I believe they're logical intention that they don't want terrorism financing or tax evasion or other illegal activities. Makes sense. I think they have become a little bit over-compassing, but okay, it's a matter for interpretation. I believe the general way the regulatory system has approached Bitcoin and similars is okay, well, most people, almost all people, will need to go through a centralized exchange to buy some or sell some. So we'll KYC them there. And so now we'll know that Antonis bought some Bitcoin on Gemini and then sold it on Gemini or took it to his wallet, and we had a capital gains, and so now we can tax him. That part kind of okay, I think. Now, you don't have to do that, right? You don't have to come into that system, but for most people, that's how they're going to buy or sell Bitcoin. And then there's a very interesting battle happening. The Trump administration tried to pass this rule before, in the middle of the night, in a way, before it left power, of exchanges would have to gather a whole bunch of information about any wallet they sent crypto assets to. They said, so we need to know where this is going. That was a little bit more questionable, because it's a tighter treatment than cash. If I go and withdraw $5,000 from the system, maybe they'll know I've withdrawn it at that time, but nobody really knows if it's in my wallet or if I gave it to my spouse or if I spend it all on tequila shots at a bar. It's not trackable after that. Well, crypto assets are. Right? Once you know, okay, this was Antonis' wallet. Oh, look, it moved. Well, whose wallet did it go to here? Well, is this an approved wallet? Oh, okay, it's the Mexican bar. Okay, that's okay. Oh, look, here they went to CVS. Well, who went to CVS? What did they buy there? It gives you actually quite a bit of visibility and control. Possibly alarmingly more than you might want your national government to have. Full visibility into every transaction. I do believe there is a balance here, and this debate is not well had. That is it important to prevent crimes through anti-money laundering? Absolutely. Is that an unalloyed objective with absolutely no countervailing costs, risks, or problems? No, of course not. There's nothing in society like that. And there's nothing in society that says, oh, I have to take crime to zero. Well, you can't take crime to zero in any society without eventually trampling all over human rights, right? silly example I like to use, but I think it's real, right? Like you could more or less take speeding to zero if anyone who went over the speed limit was put in jail for 20 years. And then very few auto deaths, speeding would come down to zero. Is that a reasonable trade-off between the risk of getting injured in a car and human freedom? Probably not. Right? Certainly no Western country has implemented a system like that. So, because there's the other risk of, if the government can see or censor every single transaction, this really applies to CBDCs, it looks good from conventional objectives. Oh, there'll be less tax evasion, we'll stop money laundering. But I think you touch into issues of privacy. I think you ought to be able to go purchase something if you like, without necessarily broadcasting it to a variety of third parties. Just as a kind of basic human dignity. I want to buy bananas from my neighbor. Is it absolutely necessary that this is in a whole bunch of databases and a bunch of people know? And I'm saying, I picked an example that's not sensitive, right? But even then, like, why is it that everyone needs to know I just bought some bananas from a neighbor? And is that relevant? You say, well, what's the big deal? I don't know. When you were in quite repressive regimes, with Stasi in East Germany, I don't think they actually ever managed to catalog every single purchase of every single person and keep it in a database. And Antonis bought 3 bananas today. And they're a pretty kind of oppressive, spying on its own population type regime. That's a lot of data for your government to have about you. Questionable, without question. Certainly might be sensitive things. Right? I want to buy an HIV test. Should that be public knowledge? Well, it's not public knowledge, it's the people, it's the government. Well, the government is just people, right? Someone knows. Is it my neighbor? Is it someone else? Should they know? Why should they know? Is it important that they know? Is the money laundering risk of me spending $30 on that just so high that we need to know? I don't think so. Right? Most money laundering happens today in cash, which is how probably most HIV tests are bought, also in cash. Well, you could ban cash. Some countries are trying to ban cash, but is that a good trade-off? I don't think so. So, okay, it's a little privacy, it's a little awkward, but look, the other things are crimes, you're stopping criminals. Yeah, but there's even a worse case. A government that has managed to gain full control over transactions, which, somewhat alarmingly, you see some central bankers in Europe and the BIS talk about. Because we want to see every transaction and be able to stop every transaction. You've given them quite a bit of power then. And so, the level of power where you start to wonder if, under certain circumstances, in the wrong hands, this power can be used for very negative political purposes. Imagine a leader, perhaps initially democratically elected, that inherits a system where everyone is known, everyone has a known identity, every transaction is tracked, monitored, censorable, and there's a system that can do this at scale. We're not there yet, but there is absolutely a goal of certain central banks to get there. Well, that sounds very good and very nice when you're in power. The trick with all these types of things is to try and imagine your worst enemy being in power and you not being in power. And if you think it's great, that the person in control of the system, which will be the government, will be able to see that their political opponent went here, ate there, spend money on this political consultant, bought ads from this marketing firm, and that you can watch their transactions in real time. Watch their, let's be very specific, campaign spending in real time. Know exactly who they're working with on their campaign. Know exactly what money they're spending. And then if you wanted to be even further over the line, block their payments in a key part of a campaign season. Oh, okay, they'll go to court or something. But maybe the election's over. You've won again. What's the remedy? Oh, sorry, I shouldn't have done that. But you're president, they're not. Not going to lose the presidency for that. And this is without going to like grand theories of you're going to become a dictatorship, but that's kind of what I'm hinting at, right? Like, it's a being able to control every single person's economic transactions, being able to censor every single person's economic transaction, is an awful lot of power to give the state. And even if you're in the bucket that the state is well-intentioned, the state, at the end of the day, is made of individuals. And maybe today you believe the individuals that are good and well-intentioned and technocratic and would never do any of these things I just described. Well, that might be true. That might be true in your country. But I think there's pretty good history that sometimes bad people come into power. Sometimes democratically elected. And sometimes people who have a less than dedicated interest in the constraints of the democratic system come into power democratically, but then try and stay in power undemocratic. And for someone who has questionable democratic ethics and mores and values, this is an incredibly powerful tool for them to use. And something like, well, I would never do that. So the question is not, would you do that? Think of like the worst person you think in your country and ask if they would do that. Because maybe someday they will be the ones in power. So I worry about this. I worry about this even if the people are well-intentioned, because you hear people that honestly I think should know better say things like, oh yeah, I want to monitor and censor every transaction. But the digital yuan is of this category, right? When you look at it from the outside, like, oh yeah, that doesn't sound great. But a lot of Western central banks are like, yeah, we're going to get rid of cash, and they kind of view crypto as being annoying in that perspective. They were managing to bit by bit reduce cash usage, move everything more to electronic usage, and now you have this thing that's kind of uncensorable. And so, okay, so what's going to happen? There'll be more KYC, there'll be more AML. What would be a kind of bad outcome, but it's quite plausible, is that this starts to break the fungibility, partially, of some crypto. Oh, these are KYC bitcoins and these are not. They went through a mixer. They came off a dark web marketplace. Sorry, we won't let you deposit these bitcoins at Coinbase to sell them. We won't let you deposit these bitcoins at Gemini to sell them. We won't let you deposit these bitcoins anywhere. Any centralized exchange to sell them. Well, okay, no problem. We'll go to a DEX. Cool. And let's say it's truly a decentralized DEX, an uncensorable DEX. You go, you sell your bitcoins, you get USDC, US dollar. Take that to Coinbase. Sorry, we can't let you deposit coins from an exchange, a decentralized exchange, that doesn't KYC, And this decentralized exchange doesn't. That's interesting. Right? Again, that's interesting, and that's without the full panopticon concern, you can see quite easily how the regulators can end up in that direction based on some things they're saying now. And so I think this is going to be a tough battle's not the right word exactly, but a tough integration or lack thereof between the traditional system and the decentralized system. But the centralized system would avoid they would say, well, okay, whatever, it doesn't matter. They can trade it with other people who live in the centralized system. That's true. It doesn't matter what you do with KYC, AML. Bitcoin is effectively unblockable, right? Uniswap is effectively unblockable. But you could end up with a world where it's unblockable, but only usable by a minority of the population that are more technically savvy, are willing to work under those conditions, who have gotten into some type of circular economy where they don't have to exchange back into fiat. Right? That's kind of the control point. The control point is, do you need to deposit fiat into crypto assets or take crypto assets out into fiat? Today, yeah, most people do. Most people earn their income in fiat. Most people pay their expenses in fiat. So most people can't really have an economic life in crypto and keep it completely in crypto. There are some edge cases, people in the crypto community, people who have said, no, I'm going to try and live completely in crypto. And I'm going to demand people interact with me in crypto. And there's some people who get away with that. Like some big crypto personalities get away with it. But we're not there yet that like average Joe can show up to his local bar and be like, I'd like a beer and nachos, and the bill comes out, and I'm not going to pay it with this dirty fiat. You need to take Monero. The bar's like, look, guy, I don't take Monero. I need dollars. So what happens there, right? He has to come back to fiat. So I think there's going to be some real tension on this line between the two systems. I think the decentralized system has a big disadvantage and a decent advantage. The disadvantage is it's decentralized. There's no one really there to lobby for it, to speak for it, to be in front of the congressional committees and say, look, this is overreach. You know, Coin Center in the United States is doing great work, but it's outmatched right now by the whole lobbying power of the existing financial industry right now. It's not a fair fight right now. And the advantage is that it actually is uncensorable. But can these types of regulations, whether they're well-intentioned or poorly intentioned, suppress the development of crypto asset model? Yeah, definitely. Will they? I think so. To some degree, yes. Was there any model that the system would not aim to regulate crypto assets? No, none. We lived this before in the internet. It was a famous declaration in the 90s, cyberspace. It's not where the laws of governments are going to apply. That turned out to be 100% false. It's a very noble intention, but it was false. And the reason it's false is we all still live in meat space, right? If you live in meat space, the major vulnerability to the crypto system isn't cryptography, it's humans. You live somewhere. You live in a nation state. You're in a physically substantiated body. What does this mean? Someone can come arrest you. If someone can come arrest you, the existing system can impose itself on you. Right? They can say, oh, look, Polemitis, we don't like what you're doing here with XYZ, please come with us. That's a tremendous power that the existing system has. That right now, the crypto system does not have any ability to insert itself into the physical domain. So the physical domain can insert itself into the virtual domain, but not really vice versa. Now this starts to hint at what type of things will start growing completely outside the system. Things that don't need physical substantiation. What do you mean? Smart contracts, AIs, virtual machines. They don't need fiat. They don't need nachos and chips. They can work permanently on Ethereum or Bitcoin or Polkadot or what have you. And that's going to be a series of activities that are going to happen outside the system. And you will have, I think, these two semi-parallel universes. Things that are still physical, human-based, which there's going to be some negotiation, some tension about how free they are and how free they're not. And I don't mean this in a strictly speaking negative way, right? There's reasons we have laws. Society has organized to have laws, and most people in general are in favor of laws. It's a question of how much, and how intense they are, and at what point is overreach, where's the balance between safety and security. Right? People say, oh, people give up security for safety, eventually have neither, right? Famous Churchill quote. But none of that is true in absolute terms, right? It's a great quote, but it's not totally true. Everyone, 99.99% of people do in fact give up some freedom for security. That's kind of the nature of society. And then you'll have a virtual world where, but virtual world doesn't mean me online. It means bots online, machines online, where those might actually work outside the system. And where that line between those two is going to be drawn, I think it's going to be the most interesting question in crypto the next decade. Right? Like that's the battle royale that's coming up. Crypto is not going to go away. The price can go up and down a lot depending on governmental actions. It's different. Right? We never make price predictions in this course, and in a way it's not the most intellectually interesting part. Right? It's fun maybe to watch it go up and down, but intellectually it's not hugely relevant. I know someone strictly saying, well, you have more security if Bitcoin price is up, so that is relevant. It is to some degree, but it's not the most interesting thing. But the question of where that line gets drawn, which societal functions get taken over by crypto, where the system can impose itself on crypto, it's going to be a very interesting question. I don't know the answer. I think the types of things I'm noting are the questions, but the answer is not completely known. All right, let me take a look and see if there's anything I can see in the chat that might be relevant. We have about 5 minutes left. Yeah, so someone mentioned in the chat, that's a good point, having had a chance to digest the latest FATF guidance, or at least about a week or so, what are its most important implications? Yeah, so FATF is the Financial Action Task Force. It's a group of countries that get together and try and coordinate their KYC and anti-money laundering practices, right? They issue guidance. It's not binding, of course, but like they issue guidance, and then a lot of countries go and implement that guidance on a national level into law. The latest draft release was extremely aggressive. So there's this concept that they've started using called VASPs, V-A-S-P, Virtual Asset Service Providers. What this originally meant was Coinbase, Bitstamp, Binance. And then DeFi showed up and has kind of caused some real consternation in the model, right? Because the consensus that had emerged through 2019 is, look, I don't know how strictly we can exactly regulate someone's personal Bitcoin wallet, but if we have them coming through the exchanges to go in and out of fiat, we'll KYC them there. We'll treat the exchanges like kind of a traditional financial services business. We think we can live with this. Now DeFi shows up and says, well, actually, guys, we're going to do the exchange part in a decentralized manner as well. And this kind of breaks that whole consensus, that whole model of how to implement AML KYC in the crypto world. And so the guidance says, well, even the decentralized VASPs have to be treated as responsible like the centralized VASP, and the people associated with them have the responsibility. I think it's poorly written, to be honest. But as it is, it's a big expansion of the scope of AML KYC. It is for sure a reaction to DeFi. And I don't know if it's implementable as it's written. I think it depends. Like, there's some DeFi protocols that are generally decentralized and some that are doing decentralization theater, right? Like, they look like they might be decentralized, but really it's just a company in California. For those, this guidance is pretty bad news, because they can come find you and say, oh, yeah, don't hide behind the kind of protocol idea. We know it's you guys. And we can find you, we can knock on your office door, and here we are, and you need to do these things. For the ones that are truly decentralized, it's not really implementable, the guidance. And so then if it isn't, what do you do? Do you go after the core developers? I mean, that would be a big break from the past. Nobody believes in Bitcoin developers have responsibility for KYCing people using Bitcoin, for example. Right? That's not a typical way it's been approached. And so I don't know what's going to happen. I think it's a very hard problem. I can understand why the system is alarmed, because a new model will need to emerge now that with the DeFi, particularly DeFi exchanges, are going to cause a lot of heartburn in the model. And on the other hand, just saying a DeFi exchange is just like a centralized exchange, it's not right either. It's not going to work either, I don't think. It's just going to push people to, even if all the current ones somehow got put under the thumb of some point, okay. Eventually you'll have a truly anonymous team launch an automated market maker and disappear. And then who are you going to go after? And then you're going to say, well, no one's allowed to use this, but I can't practically stop you from using it. But I can blacklist your coins if you use it. And so then you'll end up having kind of parallel systems, and we'll get into this breaking of fungibility of it. You'll have KYC'd coins and non-KYC'd coins, and they won't be able to interact so much in practice because no one's going to want. If you're living in the KYC'd world, you don't want the non-KYC'd coins, but if you're living in the non-KYC world, you can use them. There'll be probably two different prices for it. We're going to price for like KYC Bitcoin and not KYC Bitcoin. It's not a great outcome. It's an outcome that might happen. I wouldn't say it's an impossible outcome. It's just not a very good one. So, as I said, I think this is the central issue. And this is what at the beginning of this session, I said this is a super important topic and a very interesting topic. And it's a very interesting topic because you have to also put yourself in the head of the regulators, the mind of the regulators. They're not being totally unreasonable, right? Like the idea that you're going to say, no problem, there's no regulation, there's no tax, there's no AML in this field. They can't. Because everyone's say, oh, great, well, there's absolutely no reason to use the existing system where I'm taxed. let's use this system where I'm not taxed. You will lead to a run on society that way. And so they're not going to do that. On the other hand, there's some kind of balance to not strangle the innovation that's happening here. There's a lot of innovation. And so how you balance those two is a difficult question, and that's assuming everyone has good intentions. Put some people on both sides who have bad intentions. Maybe some people really want control on the regulatory side, and maybe some people on the centralized side are hiding behind decentralization just because they're bad people and want to do illegal activities. So how this all averages out, I actually think is the most important question in crypto the next decade. The most interesting space to watch, the most difficult to predict, but I think you can put some parameters around it. I think we did a little bit of that today. Got some parameters around the topic. And I think super, super interesting. So we're at the end of our time for this session. Dimitri, correct me if I'm wrong. The next session is George, right? So we're handing over to George Yaglis, is that right? Watch to see what Dimitri tells us. Let's see if he shows up in the public chat or the private chat for this question, but I'm pretty sure that's right. I'm going with that. I believe next week you're with my wonderful colleague, Professor George Yaglis. He is excellent. He has been in the crypto space since 2011, 2012. He is extremely knowledgeable across the board on crypto, but also even on the technical side as well. So I think you're going to have some great sessions with him. Ask him lots of questions. Pick his brain. I think he's one of the top crypto folks in Europe, to be honest. Not the world, for sure, in Europe. And so it's been a pleasure, as always, being with you. I hope you've enjoyed these sessions. I hope you continue with the other sessions. The next session is industrial applications of blockchain, right? So continue with these sessions with George. And please take the test at the end to get your certificate. You're already now 3/4 through the course. You should go through all the way to the end. Thank you, everyone. Bye-bye from me. And as always, it's been a